Good afternoon. It's great to have everyone here, and it's great to have a live event, one of our seminars and colloquia. And I'm delighted to have Poppy Allonby here to give this colloquium. I'll just add by way of background, we generally have each year when we have our external advisory board meeting for the Energy Initiative, we ask one of the members of the board to give a talk on a timely issue. This is certainly one of those, climate change and investors' view. Poppy agreed to do the talk late last spring, and we didn't quite allow for the fact that she might not be able to get into the U.S. At the time of the external advisory board meeting in late October. So she graciously volunteered to come back, to come in later once the U.S. opened up, at least for a brief window here, for travel to the U.S. So really grateful that Poppy, you're here to talk about this really important issue. Poppy is a senior financial executive. She comes to this with a passion for science. She's a physicist by training, I think proving that physicists can do most anything. She has been working in the financial sector for more than 20 years. She has spent quite a bit of time, largest part of that, at BlackRock. She was 17 years a senior portfolio manager. She was a former managing director at BlackRock. She has, during her term at BlackRock, at one point, was responsible for managing the multi-billion-dollar portfolio in traditional energy industries, so oil and gas, the utilities, infrastructure, and so on, and also had in her portfolio sustainable energy companies, so companies looking at future technologies that were low emissions. She's also had responsibility for product strategy and development, structuring and ongoing investment of over 1,000 funds, accounting for about $1 trillion. So she's had a lot of responsibility at BlackRock. Part of that was playing a critical role in developing and delivering BlackRock's sustainable product strategy for its active investment business, which is really a great contribution there. She also serves on the Board of Assets Committee for the Church Commissioners. It's one of the world's largest charitable endowments. And between 2016 and 17, she served as commissioner for the Energy Transitions Commission. She got her degree from Imperial, as I said, in physics, and she lives in London with her family. So if you would, join me in welcoming Poppy.
Okay, thank you so much, Bob, and thank you all for being here and for inviting me here. It's really an honor to be at MIT and be back in the US. I have to say it's slightly intimidating talking to you all as well, because I know how many brilliant minds there are here and how important and impressive the work that you do here is. And certainly on the energy side, when I look at the energy transition, the work you're doing on energy systems, on climate solutions and technology, like I can't think of another institution that is doing so much important work. So thank you so much. So when we talk about climate change and when I think about it, one has a range of emotions, and sometimes it can feel like we're not making enough progress. And one of the nice things about being here at MIT is that whenever I'm here and when I can't be here and I'm able to talk to Bob and some of your colleagues, I always leave feeling quite hopeful about the future and quite hopeful about all of the new technologies and work that you guys are doing to really transition energy systems and move things forward. And when you look at what's happening in the financial services sector, I'd also like to think that there's still a huge amount to do, but it's also quite a hopeful story. And over the last few years, indeed, there's been so much progress. Bob mentioned that I've been looking at this space for over 2 decades, and for a lot of that, it was quite lonely. There weren't that many other people looking at this field. And over the last 3 or 4 years, that has completely changed. And so I'd like to look at some of the reasons behind that and some of the things that investors are thinking about and what they're doing. So first of all, I'd just like to sort of frame this by thinking kind of at a high level, how are investors thinking about climate change at the moment, and why? And I'd say that when you think about investors, the first thing to acknowledge is that most investors, in fact, pretty much all institutional investors, have a fiduciary duty. And that is not a word that we use outside the financial services sector that often, but it is an overriding duty to ensure that they promote and safeguard the needs of all the beneficiaries. So for a pension fund, that might be the pensioners or holders of the plan. If you're a sovereign wealth fund, that may be the government or population. But really, the needs of the beneficiaries come first. And needs usually means financial needs. So I talk about fiduciary duty because one of the things that has really changed in the investment space is that more and more investors are beginning to see climate change and climate risk as their fiduciary duty. And you can see a few quotes there. So we've got the New York pension funds talking about, as fiduciaries, we must mitigate the tremendous systematic risk that climate change poses. So for our beneficiaries, we must do that. And again, like another example from the world's largest pension fund, GPIF in Japan, saying that these are material risks that need to be considered while investing. So I think that has been a shift. And in my mind, it kind of makes total sense. If you're investing, especially as a long-term investor, if you're investing in a pension fund, for example, or an endowment that is a perpetual endowment, and so you're thinking about beneficiaries that need assets over the next 10, 20 years, and thinking about risks that might materialize, and climate change in particular, over the next 10, 20 years, makes a lot of sense. But that is not where we were 5 or 10 years ago. Or even a few years ago. And some of the regulation has caught up to explicitly recognize this. So in the UK, for example, pension funds trustees are required to update their statements of investment principles to show how they're integrating not just climate, but ESG factors into their long-term strategic investment risks. So the next kind of risk or framing to think about this is a growing understanding that investment risk or climate risk is investment risk, which very much ties with your fiduciary duty. So you've heard BlackRock, my former employer, talk quite a lot about this, and there's a quote there that climate risk is investment risk. And when we think about, or investors think about investment risk, they typically break it down into 2 areas when they think about climate change. The first is physical risk. So what are the risks to your physical assets? So this might be property that you own that might be permanently impaired, or the value might drop because it's, say, in a coastal region. And then we also think about transition risk. So what are the risks to a business, to its profits, to its revenues, to demand, to its costs, as we transition to a net zero economy? And when you think about those risks, they are systematic. So it's very difficult for investors to diversify them away. In varying degrees, they affect the whole world, every region, and also every industry. And so when you think about, and this kind of will link on to how investors are acting. If you've got systematic risk, you can't divest that away. You really need to approach things by looking at system change. And I think when we look at risk, there is more and more of an understanding about those costs. So I think there's been a narrative for quite some time that maybe if you were investing or thinking about climate change, you might be sacrificing returns, or you might have to take some trade-offs. But more and more modeling, albeit still fairly rudimentary, is showing to investors that there is a huge cost to doing nothing. And there is some quotes there from various studies, but there's one from BlackRock that estimate the cumulative loss in global output could be nearly 25% over the next 2 decades if no action is taken. As well as the risks, there are also a lot of investment opportunities, and a lot of the stuff that Mighty are working on is kind of at the early stages of that. But there are growth areas. This isn't all about negative risks. There are also opportunities in renewables. There are opportunities in energy efficiency. There's opportunities in the automotive space that can also provide big positive wins and opportunities. And the next point I wanted to talk about was around moral priority and values driven. So maybe you should care about climate change or think about it from a moral perspective. I have no doubt that many investors really do care in their hearts about climate change at a personal level. But in terms of driving investment decisions, this is not something that we come across too much. And really, when you look at moral priority or value-driven investment, where you're seeing money being deployed because you have a really strong view on this, is really only seen amongst certain charitable organizations, and also I think in the private wealth market. And this really comes back to the reason for this comes back to one's fiduciary duty, that you have an interest to look after your end investors and your end clients and your end beneficiaries, not your own views. And so you have to make sure those are totally aligned. So I think that gets talked about, but when you really look at what institutions are doing and institutional investors, it's not something that crops up that much. I think one thing that everyone agrees on in investment and everywhere else is this is a challenge and it's not easy. And we'll come on to some of those challenges in a moment. So when I sort of talk about climate change and climate risk, for me it seems quite obvious. And for some investors it is also quite obvious. And I was chatting years ago actually to the chair of one of the large endowments. And I was just talking earlier about this conversation. And he said to me, Poppy, when you look at the portfolio and you look at all the risk that he has in the portfolio and all the uncertainty, there's so much uncertainty. You don't know who the next US president is going to be. You don't know what interest rates are going to be in 10 years' time. You don't know what currency rates are going to be in 10 years' time. You don't know really what global economic growth will be. And he said to me, Poppy, with all of that uncertainty that we have to make estimates about, one thing I feel confident in is that over the next 10, 20 years, we are going to be dealing with climate change. And so why wouldn't I be investing the portfolio with that in mind? And to me, that seems so obvious that you sort of think, why isn't everyone thinking like that? But not everyone is, not every investor is. And various investors in various parts of the market at very different stages in considering climate change in their investment decisions. And I've just done a little schematic just talking about some of the things investors might want, or institutions might want to consider. And the first is, of course, they have to recognize that this is important and relevant to them. And once they realize that this is something they need to think about, they need to understand how and why. And that really means looking at the risks and doing a risk assessment of your business. Then you need to develop a strategy. And that needs to involve governance. That needs to involve targets, metrics, and actions. And then, of course, you need to execute that and measure and report it and reevaluate it over time. And when you look at different institutions, some of them are just at the very beginning of this journey. Some might not have even started. And thinking kind of in a very broad brush way, what we see is that geographically, European investors tend to be a bit further ahead on this journey. And by asset class, we see the listed markets, so listed companies being way more ahead and asset managers who are involved there than the private markets where there's still almost no data. And when you look at private equity, venture capital, many of these guys are thinking about this, but in terms of putting in place very structured, systematic approaches to integrating climate risk into their investment decisions, they're at an earlier stage, typically, on average, than some of the more established asset owners, asset owners and investors that are more on the liquid side. So what can investors do, and what are they doing? And there are a number of things they can do. The first is they could obviously divest of their holdings. So where they see risks, they could divest those companies. And maybe that's something that a lot of people want to talk about typically, and that maybe it's something we can cover in our discussion, Bob. Like my personal view with divesting, by saying maybe that, say, oil and gas companies, you want to divest from them, my personal view is that's not very effective. I think there might be examples where you've got very specific companies which you don't think will be involved in the transition, where that might make sense. Or if you've got, you're a certain institutional investor that is imperative that their investment is entirely aligned with their values, so certain charities, that might make sense. But if you really care about change, I think you just need to keep a seat at the table. One of the other things you can do is you can try and have more of a positive impact and invest in the companies that you think are going to benefit from this transition. So you can look at climate solutions or sustainable investments. Another thing, and I think this is where I'd like to think where the industry is heading, is integration. So this really means all of the above. This means sort of thinking holistically around pretty much every decision you make as an investor, and thinking about how climate change is going to impact that investment. And that is a kind of complete sea change in mentality around how you invest. It doesn't necessarily mean investing in impact funds or ESG funds. You just change the way you think about investing. Another area, and I think integration ties very much into this, is engagement in voting. So how do you use your vote as a shareholder, and how do you use your position as a shareholder to work with companies to try and improve outcomes and drive towards a net zero economy? Collaboration advocacy is sort of similar, but perhaps working with other investors and other organizations rather than directly with the companies you own. And measurement and risk management has obviously got to come part of that if you're kind of going to properly integrate and think about climate change in your portfolios. So let me just talk through a couple of examples. Sorry, I was getting ahead of myself on the slide. So when we look at sustainable investments, recently the good news is that a lot of sustainable funds have done very well and are attracting capital. So this chart shows, as an example, the performance of the S&P index against both the S&P Clean Energy Index and the S&P 500 ESG Index, which is the S&P ESG index is an enhanced index. So what they have done there is not divested any companies, not made targeted investments in climate solutions. They've taken the S&P 500 and effectively optimized for it by trying to invest in the best-in-class companies in every different sector. And what you can see there is that over the last 5 years, the enhanced index has outperformed by about 2% every year, and climate solutions has done brilliantly. Although you should also see that it's been very volatile. So it depends on your holding period, because if you'd bought this time last year, I think you would have had quite a rocky road. Now that's just to give you a snapshot, and it's a very short period of time. So when you think about how much data we have in this space in terms of measuring performance and trying to make an argument that it makes sense from a financial and investment perspective, from a performance perspective, to invest this way, our data set is very limited. We do have, as well as these indices, there are a number of studies that have looked at fund performance. So if you look at some work that Morningstar did last year, they looked at about 745 sustainable funds that use ESG criteria. And they looked at that and compared that to a universe of about 5,000 funds. And that they found that over both 1, 3, 5, and 10 years, the ESG funds outperformed the broader index to the end of last year, or the end of 2019, and that continued through 2020. But again, the data set is still quite small. Cambridge Associates, local company here, they're an investment consultant. They did quite a bit of interesting work specifically on EM markets, emerging markets, and they developed an ESG index that tries to adjust for style biases that you might get in normal ESG indices. And they found that that ESG index outperformed by about 2.5% annualized over the 7 years they have data. And roughly 60% of that was entirely explained by ESG-based stock selection. So there's growing evidence that investing in climate change or investing with the climate change mindset is not just good for the world, it's also good for your investment returns. But as I say, the data set is open to scrutiny because it's still quite narrow. What we're also seeing is that these funds, these ESG funds, are attracting capital. So we're seeing about half the flows, over half the flows, investment flows going into mutual funds are in the sustainable, are going into sustainable funds. So they're growing really quickly. I think the annualized rate of growth is, I've got it written down here somewhere, but is kind of north of 30%. And we're also hearing, as well as the public data that we have on mutual funds, you can pick out lots of anecdotal data from institutions that shows that there are increasing capital to this area. So for example, when you look at the New York pension funds, they recently, in the last couple of months, announced commitments to double their exposure to climate solutions to about 8 billion by 2025, and to increase that to over 30 billion by 2035. So there's more and more momentum and assets going into this area. So that is encouraging. There are also a few good stories, I think, around the engagement side, which is really sort of support my view that this has more impact than divesting. So I've got 3 kind of examples of things that I think are going well. The first is an example on Climate Action 100+. So I don't know how many of you are familiar with that group. Some very familiar. So this was launched back in 2017. And it's a group of investors. And it was designed by investors for investors. And the aim of the group is to ensure that the largest corporate greenhouse gas emitters take necessary action on climate change. And so they have done this really by working together to achieve scale and then engaging and leading engagements with different companies. And they do dozens of these every year, and the members take it in turns to lead those engagements. But I just picked out some examples of where they're having action, and I picked out some examples from their 2019 report. And just to read off a few. So they engage with Exxon Energy, which is a major US utility. And as a result, that company set out an intention to reach zero carbon electricity by 2050. They engage with Duke Energy. And as a result, Duke announced an update to its carbon transition plan with a 50% reduction to greenhouse gases by 2030 and to have net zero emissions by 2050. They worked with Glencore, which was the world's which is the world's largest exporter of thermal coal, and Glencore agreed to cap coal production to current levels. They engaged with Maersk, which is the world's largest shipping company, which then committed to net zero emissions by 2050. They worked with VW, who then committed to become climate neutral by 2050 and launch nearly 70 electric vehicles by 2028. They worked with Rio Tinto, who then exited mining coal, published a TCFD report, so massively improved their climate disclosures, and committed to an asset-by-asset review to set emissions and reduction targets, and the list goes on and on and on. And I think that's a great example, not just of engagement, but of coalition building, and when investors working together can have a real impact when they're all agreeing to drive for the same sorts of things. The next story I want to share is one around the Exxon Proxy contest, which was probably one of the most hotly watched contests in years. It happened this year, but this had people like me at the edge of their seat. And just to give you a little bit of context, you have to kind of step back to kind of just see the bigger picture of what was going on in the oil and gas industry and the investment industry. But if I've been talking about investors getting more active here and engaging through Climate Action 100+, another thing that has been happening is that some investors have been actively filing shareholder resolutions, often with oil and gas companies, but not exclusively, and pushing in these resolutions companies to take action on a whole range of issues, whether that's carbon disclosure, having carbon-aligned business plans, linking executive pay to environmental and social measures, or setting emissions targets. And this actually happened, or started to happen, in earnest, I'd say, even before the Paris COP. So Exxon has faced such shareholder resolutions for many years, and in 2018 and 19 faced a proposal to set out by investors to set short, medium, and long-term targets for reducing greenhouse gas emissions, including those in Scope 3 that were released by the products they sell. And so in both these cases, Exxon asked the SEC to throw out the shareholder proposal, which the SEC did. And with the resolution blocked, the institutions that tabled, those minority investors that tabled that motion, recommended to vote, that shareholders vote to split the CEO and chair roles. So at the moment, or at that time, it's still the case, the CEO and chair roles were both held by one person, by the CEO of Exxon. And it's common in companies for those to be split, to have an independent chairman. Not in all companies, but that is not unusual. So that vote to split the CEO and chair roles effectively became a litmus test for support for the board's position, Exxon's board's position on climate. And so the outcome of that vote in 2019 was that 33%, a third of the investors, voted to split the chair role. And look, on the face of it, it's a victory for Exxon, like they won the vote. But you've got to sort of sit there and think that a third of your shareholders are like not happy at all. And there's a lot of discontent. So that's the sort of backdrop in terms of the environment that is kind of leading up to this proxy contest. So if you fast forward to pretty much this time last year, this little company that no one had heard of, called Engine No. 1, published a letter to Exxon's board calling for much-needed change, including an overhaul of management compensation, greater capital discipline, and a strategic plan for sustainable value creation, including a net zero plan and also new board members. So, I mean, this is quite an unlikely story. So you've got this new little company. They're tiny. They only own about, I mean, it's a lot of money in kind of normal terms, they owned about 40 million of Exxon stock. So, I mean, it's not a small amount of money, but in the context of Exxon, it's tiny. It's like 0.02% of Exxon stock. They did have support from some institutions. So a number of institutions came out in support of them, CalSTRS being one of the big ones. And they decided to nominate 4 directors to the board. So they put forward a slate of 4 directors. And this is quite activist, on the climate side. I've been looking at this space for a long time, and I can't think of, you have activist investors, they put forward board slates, but this definitely had a climate angle. And so how did Exxon respond? Well, they responded by saying that none of Engine number one's directors met the standards or the need of the company's board. So they were not willing to give ground on that. But they did make some concessions. They appointed 3 new directors of their own, and those had energy and investment experience. They unveiled a low-carbon business. They cut CapEx, and they reported on their Scope 3 emissions. But that's quite a lot of movement from it that Engine 1 created. But Engine 1 did not think that was enough. And so they took this all the way to the proxy battle. So the board goes to, not the board goes to vote, the board slate gets voted on by shareholders in May. And this really went down to the wire. I mean, the results are usually for these proxy contests or for any proxy vote. You usually get the results in the AGM, like you've already collected all the votes or most of the votes, and the results were announced pretty quickly. But this, from memory, we didn't get full results for a couple of days. And in the end, Engine number one won 3 out of those 4 board seats that they proposed. So, that's less than 6 months ago. So time will tell what impact that will have. But it's a story, I think, of increasing activism with not purely a climate lens, but a climate lens nevertheless. The last thing I wanted to highlight as an example where I think things are going well on the kind of collaboration and engagement side is the work Mark Carney's been doing to pull together financial institutions to really make commitments around moving their businesses and their portfolios, if you're invested, to net zero. And importantly, I think, reporting on that progress. So from an investment perspective, Mark Carney was very ambitious and looked at the whole financial services industry. But from an investor perspective, the 2 kind of main groups that are critical are sort of 2 alliances. The Asset Owners Net Zero Alliance, which represents about $10 trillion. That's typically sovereign wealth funds, pension funds, endowments. And then the Asset Managers Alliance. And that is the people who are running that money and a lot of the big asset managers. And those assets they've committed to that total $57 trillion. I mean, these are huge, huge numbers. And these are big investors or big investment managers committing to transition their portfolios to net zero by 2050 and be accountable for that in terms of reporting on their plans and progress regularly. And the only way you can do that is for these companies and these investors to engage with their portfolio companies and encourage them to make net zero plans. You cannot achieve that, I don't think, in any other way. And roughly where we are today is, if you look at the largest companies around the world, about 30% have set net zero targets. And there's a big difference, obviously, between setting targets and getting there. But that is, and 30%, there's still a long way to go. But that is a lot more than it was even just this time last year. So these are areas where I think we're seeing some real tangible examples of progress. But there are still a ton of challenges. The first one I haven't even written on here, but it's probably quite obvious, is that some investors still need convincing that this matters and is relevant and is material for them in the timeframes they're operating. But once you move beyond that, there are real questions around data quality and lack of formalized methodology. So, I mean, we can talk a little bit more about this maybe in the Q&A, but that can be for everything from the accounting side to the carbon emission side. People often cite lack of investments in products. I think both of these areas we're seeing big improvement. The area where I think we still have quite big challenges is getting the capital to where it's needed and the scale of the capital to where it's needed in emerging and developing economies. And what are investors asking for? They're typically asking for solutions to those above problems. So much better disclosure and transparency. And I think things like the TCFD or TFCD and things like the Transition Pathway Initiative and sustainable accounting standards, these are all improving, moving things in the right direction. They're asking generally for net zero aligned business plans. We've already covered that. Carbon pricing. And I think for the developing markets, more shared risk sharing between the private and public sectors. And what might we expect investors to turn to going forward as areas of focus? I've outlined 3 things here. The first is we're starting to have, and there's starting to be more conversations on natural capital and biodiversity. And things like the Task Force for Nature-Related Financial Disclosures was launched last year. So that's very similar to the same task force for climate-related disclosures. And we've seen all the commitments on COP from deforestation. And what we might start to see is more investor-led engagement with corporates on what they are doing and what their supply chains look like from that deforestation perspective. I can only imagine we're going to have more shareholder action. I'm not sure if it will be quite as dramatic as what we saw this year at Exxon. But it might come through tabling proxy motions. But I think another area that is interesting from investment perspective is maybe a little bit more below the radar, where investors could work with companies in a more collaborative way to help them improve their climate strategy, disclosure, and communication, with a specific view to add alpha. If you can buy assets that might be discounted or cheaper because people have real concerns about their environmental footprint, and then you can work with those companies to improve it, and therefore maybe reduce the risk and improve the valuation. I think that looks like quite an interesting area to pursue. And then I mentioned at the beginning that the private markets are still well behind, and I think there's going to be more and more pressure on private equity and VC to kind of up their game in this space. So that is some thoughts, and I'll leave it there, and I think we're going to have a discussion about some of those in a bit more detail. Thank you.
So thanks very much, Poppy. That was great. We're going to do a few question and answers up here, and then we'll go to the audience for questions. We'll have some handheld mics that will be available on the aisles. So let me start with a question you mentioned early in your presentation, interest rates.
Oh, yes.
And I wanted to ask about the fact that we've had a sustained period of very low interest rates now for some time. How important has that been to getting the kinds of money invested in energy transition that we need? Do you worry about inflation and what that might do to the funds available for investment? Could you comment a little bit on that?
Sure. So one of the impacts of low rates, and we've had them for a very long time, is that it's inflated asset prices, and it's also created a huge desire for investors to take risk as they look for returns. And so this isn't specific really to the climate space, but what we're seeing is a huge amount of capital for risk assets. So when I think about risk assets, I mean, that's, equities, venture, technology. And the good news is, from kind of climate action perspective, is that for many technologies in many parts of the world, access to capital does not seem to be a problem. And anecdotally, I chat to people in the kind of venture space or people who've set up companies, and they're like, capital is not a problem. We're able to attract it. People want to invest in this space. People want to take risk. That's, I don't think, the case everywhere in the world. And I mentioned developing markets as maybe a different scenario. And a lot of that desire has been, a lot of that risk capital, or some of it, must be predicated on low interest rates. So if cost of borrowing goes up and interest rates go up, I think that poses a risk to the value of all sorts of financial assets, as well as this. So I think that this space has certainly benefited from the desire to put capital to work in risk assets.
Good, thank you. So let me ask a question in the context. A lot of the conversation at MIT has been around what can we do with what we have now. So what do we do in the next decade with technologies, policies, so on that are in place, and what is the agenda for beyond 10 years from now, so 2030 and on? How do you look at that as an investor, or do you? I mean, what kind of focus do you have for the short term, I'll call it 10 years, versus much longer term?
Well, I think, listen, one of the biggest challenges on the climate side is this mismatch in investment horizons. And most investors do not think about 10 years as short term. They think about 10 years as very long term.
Right.
And a lot of investors are looking at sort of 1, 3, 5 years. And so actually, I think one of the biggest challenges with really kind of integrating climate and thinking about investing in these areas is this sort of mismatch between timeframes, and that you've got a lot of the investment community that is thinking in much shorter time horizons than what is required when you think about climate change and some of these technologies. So most investors are focused on what is here and now and bankable here and now. And one of the joys I have in coming to, talking to you and being here at MIT is kind of peering around the corner to sort of see what you guys are working on, that is what is coming next. And so, yeah, I think not many investors look at 10 years. Even kind of long-term capital that you might think in private equity or venture typically have shorter time periods and time horizons than that.
We had an interesting example, an announcement today, or an article in the Wall Street Journal about Commonwealth fusion systems. We talked a little bit about that this morning. The fact that it's $1.8 billion put into a technology that's more than 10 years out. So
I know. Well,
there is.
Well, that's wonderful. More investors and more, more investors should be thinking longer term, in my view. And some do, some do, and some corporates who are thinking very much on those timeframes. So I think that it's absolutely wonderful hearing that and reading that Wall Street Journal article.
Yeah.
And great for MIT.
Yeah. So you mentioned early on mispricing climate change in markets.
Yes.
Could you say a little bit more about that? What drives that? Is it getting better or worse with time? How could we do a better job at pricing climate change in the markets?
Yes. So there's a question: is the market efficient in this area? Like, is the market correctly pricing climate risk? And my personal view, and it's not backed up by detailed models, my sort of common sense view is that it can't be. We don't have the sort of tools or the mentality to sort of do that properly yet. And I sort of even just think anecdotally, like you look at the property prices of waterfront property in Miami or Martha's Vineyard or wherever, and you kind of think, well, when people buy those properties, are they thinking like, well, what is this? What are the risks for these coastal regions and the risk of asset impairment on a sort of 20-year view? So my sort of view is that we haven't really got our arms around that as an investment industry. Now, from purely investment perspective, that's also an opportunity, because if you can, and you're a sophisticated investor, sort of start thinking about those things, then you're going to be better positioned than others. So why is that? Well, I think one reason is a time frame issue, which we just kind of covered, is that you have this mismatch between investors that many investors that might be thinking on much shorter time horizons than what is required. And I think that the other issue is around some tools and kind of mentality, is that many investors, when they sort of think about the future, or they try and model either what companies' earnings are going to be, or how an industry is going to play out, or their risk models, they start with where they are today, and then they move things up a little bit or down a little bit. I might say, we'll do a shock. We'll see if we'll do a 10% move. And that doesn't really work when you think about a very forward-looking potential, like massive change. Now, often when investors try and think about big changes, like big dislocations, they go back to looking at history. Like, what happened when we last had an inflation shock? Like, what happened? What happened when we last had a recession? What happened when interest rates last went up? And they go back and do their modeling and then kind of think about how that might affect assets going forward. That doesn't work for this sort of problem. So really, you need to actually have a wholesale different thought process to how you think about modeling returns, future returns, and modeling risk, which, I'm not sure anyone's cracked yet. I know people are working on that problem, and others will have different perspectives, but I think that's still not the norm. But my hope is that, and it's not really just a hope, I think it actually will happen, is that we'll be sitting here in the future, and we won't be talking about climate risk or sustainable investments. This will just be normal investing. This will just be how one thinks about some of these external risks.
So let's open it up for questions. Raise a hand and we'll bring a mic to you. I see Maria's got a hand up. Right up front.
Great. Thanks a lot for that great presentation. So this goes back to maybe the second question that Bob asked you about short-term versus longer-term. So if a company says that they're going to be net zero by 2050, arguably it's the least accountable thing that they can say, because nobody who's in the company now is going to be there in 2050 to take the heat if it doesn't happen. And are those kind of commitments meaningful at all if there isn't a plan to decarbonize by whatever % by the next 5 years? I'm thinking about, look at what the Australian Prime Minister said, we're going to be net zero by 2050, but didn't commit to anything to speak of, at COP26.
So I think it's right to be skeptical of all commitments. And I think it's right that you have, and it should be encouraged to have people, individuals, groups scrutinize how companies or investors are doing versus their commitments, and hold them accountable. Now, I think when you look at from on the corporate side, Like you look at some of these commitments on that the investors have made on net zero. Part of that commitment is to have a plan and report against those actions at regular intervals, and not every 5 years, but every year, I think. And so I think that is how you can kind of drive some accountability and measure progress. Is, to like show how you're doing and disclose how you're doing versus those targets. I think that's the best way. And there are a number of initiatives also underway that track that. So we were talking earlier about the Transition Pathway Initiative, which has looked at corporates and investors, and it looks at their net zero plans. And also, what not just their plans, but what actual action have they taken? What is the governance? What is the strategy? How engage management? Like, is it going to happen? And they track companies' progress over time. And so by industry, you can kind of just have a look, and anyone can have a look at this. It's all open source data, freely available data. You can look at, say, the energy sector, and you can look at, okay, well, for the big, large companies, who's got a completely net zero plan that is being actioned and credible, and there is accountability and governance around, and who hasn't done very much, and who's in between, and how are they changing over time. So more and more, there is sort of scrutiny on that, which is great.
Good. So yeah. Why don't we do another one on this side and then take a mic over the other side?
Thank you. You covered a lot of ground. I'd like to ask you, there's been a lot of news about divestment, for example, pensions and City of Boston and so on. And BlackRock certainly discussed quite a bit about divestment versus engagement. What would you say about the idea that critics of divestment have said that it tends to drive fossil fuel assets into private equity?
Yeah. So I think that there are sort of if you're looking at the divestment question, which is if you're an asset owner, should you own the fossil fuel companies? Like, should you invest in those companies? So my view is like divestment doesn't necessarily have an impact, part because of the points you've raised. So at its extremis, imagine a scenario where you've got some company that is maybe produces some useful good, but does it in an incredibly polluting and non-environmentally sustainable way. And they have shareholders that aren't that happy, but they don't do anything, and those shareholders decide to divest. So what sort of, at the sort of extreme level, what happens as a result of that potentially is that the company kind of sits there and goes, oh, that was easy. I didn't have to do anything, and they've gone away. And potentially those assets, or the shares in those companies, end up actually being owned by people who care less. And so I think that is a risk that one, when you think about divestments, one has to kind of have in one's mind. Now, I think there is a question, maybe what you're referring to is divestment of assets, is that what you were referring to? Like if you're an energy company divesting assets to get to your net zero plans?
Just that it would tend to drive it into private equity.
So it could end up, those assets, say you're, it may not be that those energy companies end up going private, but they could sell, in order to get to their net zero plans, one of the ways they might do that would be to sell their most polluting assets. And that could end up with owners where there is less transparency and less scrutiny. And I think one has to be mindful of that when one is asking that question. And I think this is also why people ask more and more questions in the private markets around what are these, of the LPs will ask the GPs, what are they doing? And a lot of institutional investors are also investors in private equity. So I think, I think that's where the conversation will go, is more and more scrutiny and questions asked on the private side. But it doesn't protect completely because of that risk.
Thank you. There's a question over here.
Hi. Jason Jay from MIT Sloan. I wanted to just go further on this divestment engagement question. So you said in your talk that there's that and I'm generally with you on this, engagement has a lot more evidence behind it for making change than divestment does. But you said that there might be an extreme end where you just want to get out of that asset because the transition risk may be too high, and even with shareholder engagement, you may not be able to make a difference because maybe they're too locked into their physical infrastructure in the coal space or something like that. How do you think about drawing that line where engagement is going to be fruitful and is going to get significant decarbonization versus where you're probably better off? With the caveats that you just gave, which is that when you sell it, you might be selling to somebody who cares less. But just from a transition risk, fiduciary duty perspective, you might have to get out of it. How should we think? How should we think about where that line is?
Well, you're not going to like the answer because the answer is it's very subjective, and there isn't like a sort of clean, neat answer. I think that different investors will have different perspectives. Every institution is unique. The engagements are unique. So I think, in reality, you're going to have to look at that on a case-by-case basis. So I'm sorry, that's not a neat answer. I think it's hard. And some institutions might have time periods. They might say, we're going to give you until this, we're going to do however many years of engagement, or we're going to try this, and if that doesn't work, we're going to try that, and if that doesn't work, we'll try that, and if that doesn't work, then we'll get out. They might draw a line and say, actually give a company, have to set themselves or companies time scales. So I think there are a few ways you can approach it, but it's not it's not easy. And I think every investor and company will be a slightly different case.
Thank you for a really interesting and thoughtful talk. You've talked about how investors typically do not think of 10 years as short-term, and that most investors are thinking more about a 3 or 5 year time period for evaluating risks. What about fossil fuel majors? I mean, from their point of view, what's short-term and what's long-term, and are different companies thinking about this differently in terms of how much they seriously invest in making an energy transition?
Well, maybe you're better off to answer that one, Bob, or share some thoughts. I mean, I think I should first of all, there will be investors who think much longer than 10 years. So I don't want everyone to think that not, all investors are thinking very short term. And when you look at, for example, some of the big endowments, they're very, very long term in terms of their thinking. But the corporates, they have capital cycles that are of 10 years, 20 years. And so, you do a lot of work with them on the R&D side, but they tend to have and can have quite large and long-term thinking. And the example you gave on the fusion side, some of that has been supported by corporates.
Right. I mean, so I think there's a place where the long-term horizon that oil and gas companies are used to actually was quite helpful. With Commonwealth Fusion Systems, some of the early investors were oil and gas companies, and a horizon 10, 15 years out there didn't cause them any trouble at all. And so they were willing to, after doing a lot of due diligence on understanding the technology best they could, they invested. And that was quite useful. So, that's the good side. I mean, a challenging side is that it takes a long time for the research you need to do to get out into the field in that area. And although my observation is that the research portfolios have shifted quite dramatically in those companies over the last 5 years. It's going to take time for that to filter into the operations. We have a question over here.
Okay. Thank you. I'm Pablo. I work here at the MIT Energy Initiative. I wanted to come to your point of 10 years is a long time frame, and also that there's a mismatch between here and what's now. And I was thinking, well, the link between those is building today or investing today in the brownfield infrastructure that we need for tomorrow, right? It's doing those mines or solar panels or anything. And how do you feel our institutional investors, major investors like BlackRock, what's their position with that in terms of investing into actually building this transition and not just owning stocks?
I know investors are doing that for sure. So when you look at, and this is why, I mean, I made this sort of sweeping comment about investors having a shorter term view. I still think there's a mismatch, but there are certainly asset classes and areas where investors are taking a longer term view. So infrastructure assets is an asset, fairly established asset class, including renewable infrastructure now. And so there are a number of funds available by a number of asset managers where you can invest in renewable power plants, solar power plants, and then they yield a sort of income and return. So that's, that's actually quite established. And absolutely, like those, those projects are getting funded. Sorry, did that? Yep.
What I meant is, since it's such a standard asset class, what is stopping you from scaling up these type of infrastructure? Since access to capital.
So when I was making kind of broad comments. So when you look at, and if you were to look at a pension fund or an endowment or a sovereign wealth fund, a lot of them own infrastructure, but it's a relatively small part of their portfolio. So the larger parts typically might be like their equities market exposure. The pension funds often have like a fixed income exposure. So infrastructure, the asset allocation is usually quite a bit lower. So it's not a question of those products not getting scale in their own right. I was thinking about it more scale from a portfolio perspective in terms of what percentage that typically is. Sorry, it's just a different lens. Like I don't think there is a capital, I don't have any evidence that there's a lack of capital going into those markets, developed markets.
So we had a question over here, one more.
Thank you. Earlier this year, BlackRock launched an ETF that raised $1.25 billion in a single day.
Wow.
That would end up in the ESG integration bucket on your presentation. It was called the U.S. Carbon Readiness Transition Fund. And it was really popular, as evidenced by how much it raised. But if you look at the prospectus and look at the holdings include information services companies as the number one holding, healthcare is number two, but they own also Exxon, Chevron, Dover Industrials, JP Morgan, a whole bunch of energy companies. And from my perspective, that's not going to get us to where we need to go in terms of energy transition. And so I just wonder about your thoughts about how ESG is in fact regulated today, and how much of the money that you're describing as ESG assets are really going to towards transition?
That's a good question. So on the BlackRock fund, I don't know it. I'm not working there at the moment, anymore, so I can't comment on that in particular. But what is absolutely right is that ESG and being green and climate change means a myriad of different things to different individuals. And there are a myriad of products out there, from everything from a screen, we're not investing in fossil fuels, to something that might be more, and I don't know the example you have, but it's more optimized way of saying I'm going to invest in every sector, but I'm going to try and take the better companies, through to actually there are I'm going to really invest in companies that I think are forward-looking and going to be there in the future. So there's a whole myriad. And when people talk about ESG, as you've said, they bucket everything in together. And so I think that there are a few things. I think there are a few sort of trade-offs and things to consider. I think the first most important thing that all managers should do is be very transparent about what they're doing. So, and then stick to what they say they were going to do. So be clear about, as clear as you can about your approach and why you're taking it. And then, for different investors will want different approaches. So you just got to be clear. And then I think we will start seeing more, as our industry matures, and through regulation or elsewhere, we'll start to see, hopefully, like maybe some more standardization, at least in how we describe things, so that it becomes less confusing. So I think you're right, that there's a whole range of different approaches. It can be confusing. And at the moment, the best answer to that is to be really clear and transparent around what you're doing and enable people to make the right choices.
Okay, maybe one last question here. Yeah.
Thank you. And this has been an excellent talk. Thank you. I'm wondering about what kind of guardrails and things can we encourage an investment community, or can we guide the investment community to do, to look to the more risky developing markets? Most of the world is a developing market. They're already paying high interest rates, which you sort of, I don't know, in some ways we dismissed it in our discussion. What kinds of things can we help to set up and push to set up that will help redistribute some of this wealth to making the capital improvements for the rest of the world, and the ones who are feeling the most climate impact in many ways?
It's absolutely a super critical question. And, in COP, there's a lot of talk about the 100 billion or so that was it really that was pledged to developing and emerging economies, and had more developed world done what they should have done in terms of paying that and what's going forward. But the bigger number, the number that probably is needed, whether you look at the IEA or other reports, is probably closer to $1 trillion. $1 billion $1 trillion a year. And so there's a huge amount of capital that is required in those markets to transition. And it's not getting there at the scale that is required. So I think that there are a number of actually quite practical things that could be done to kind of unlock that capital. There are a number of barriers that investors kind of face for investing, not just in climate solutions, but generally in emerging markets. And there are a number of ways you could tackle those. So, this could be a full hour's talk, just all discussion in itself. But investors get nervous around, currency risk, regulatory risk, reputational risk. And not only do they get worried about those risks, but I think the more practical thing is they don't have the resources or know-how on the ground to kind of originate a lot of these investment opportunities in scale. And so I think that there's a huge role for some of the development banks and the like to really look at how they can work with financial institutions and the financial community to kind of unlock private capital. And it's not working at the moment at the scale it needs to, so that I think that you really need to rethink some of those models in terms of some of the public capital, frankly, to kind of make that happen. So there are a number of very specific actions one could take. I think you could be, instead of instead of the development banks investing their own balance sheet, they could be offering guarantees for private investors. That could come in all sorts of ways. It could come as like a first loss, for example. If they did that at a more like, I would say, a portfolio level, like across lots of projects and regions, that would also be massively helpful in terms of scale, rather than at an individual project by project basis. I think those institutions are also incredibly well positioned to solve the problem of origination and standardization and legal frameworks, because they are present, they have a pipeline, they can drive more sort of standard investment terms, they can create like project templates. So I think that there's a huge number of things that can be done. I actually read a report last week, which was just published by, I think it was this Asset Owners Alliance for Net Zero. And they've put together a consultation paper as sort of big asset owners on what they see their issues are and where they think you could solve for them. And I read it and I was like, oh, that's all of my views. Perfectly summarized. I could have done it better. And that would be worth kind of looking at if anyone is interested in that topic, because it's very specific about why investors find this hard. But what I like about it is I'm quite solutions-minded, and it has sort of all the reasons why we can't do something. It's like, well, these are the ways in which it could work, and what we need. So it was quite action-orientated.
Good. Well, thank you very much, Poppy. Join me in thanking her once again for a great colloquium. Thank you.
Thank you for having me and all the questions. Thank you very much.
No, that was great.